$3,000 for the first time in human history. But here's what they're not telling you on the evening news. Central banks, the very institutions that print your money, are quietly, systematically dumping their own paper currency for metal, China, Russia, Poland, Singapore, even Switzerland. When the printers of money stop trusting money, what do they know that you don't? The commercial banks are trapped. The margin calls have introduction, boring economy started. And the Basel III deadline just activated a buy signal that cannot be reversed. This isn't a rally, this is a regime change. And what happens in the next 72 hours will determine who survives and who doesn't. Welcome to Boring Economy, the only channel where numbers tell stories that Wall Street doesn't want you to hear. Now, if you've made it this far and your hair has more wisdom than color, do me a favor. Hit that subscribe button, the way you'd grab the last seat in a boardroom, and drop a comment below. Tell me what corner of this spinning planet are you watching from today? New York, London, Mumbai, Lagos. Let's see who's paying attention. On the morning the gold price crossed $3,000 per ounce, something fundamental shifted in the global financial system. This was not just part one, historical context and market mechanics, another number on a chart. For 50 years, since August 15, 1971, the world had operated on a promise that paper currency backed by nothing but government decree would hold its value. That promise was now being questioned by the very institutions that made it. The technical charts told a story that professional traders recognized immediately. Gold had broken through resistance levels at $2,000, then $2,500, then $2,800. Each time the metal paused, consolidated, and then surged higher. But the move past $3,000 was different. There was no pause, no consolidation, just vertical acceleration, market. Analysts studying the volume data noticed something unusual. This wasn't retail investors buying gold coins from their local dealers. The volume was institutional. The transactions were measured in tons, not ounces. Someone with very deep pockets was buying everything available. The futures market revealed another critical detail. In normal markets, traders bet on price movements using leverage. They buy contracts, not physical metal. But at the $3,000 break point, something broke in that system. The open interest, the total number of outstanding contracts, began to collapse. Traders were demanding physical delivery. They no longer trusted the paper promises. This created what market veterans call a squeeze. Banks and hedge funds had sold gold short. They had bet that prices would fall. They had borrowed metal they didn't own, sold it, and planned to buy it back cheaper. The strategy works until it doesn't. When gold crossed $2,800, these short sellers received margin calls. They had to post more collateral or close their positions. Many chose to close, but to close a short position, one must buy. And when everyone buys at once, prices explode. The structural foundation beneath this rally was years in the making. In 2019, global banking regulators implemented something called Basel III. These were rules designed to make banks safer after the 2008 financial crisis. Buried in these hundreds of pages of regulation was a single clause that would change everything. Physical gold held in a bank's vault was classified as a Tier 1 asset, the same classification as cash. This meant banks could count their gold holdings toward their capital requirements. But there was a catch. It had to be physical allocated in the vault. Paper gold, futures contracts, ETF shares, none of that counted. Overnight, every major bank became a buyer of physical gold. But the demand didn't stop there. Central banks, the institutions responsible for managing national reserves, were accelerating their purchases. Data from the World Gold Council showed a pattern. In 2020, central banks bought 255 tons of gold. In 2022, they bought 1,082 tons. In 2024, the number exceeded 1,500 tons. And these weren't small developing nations. These were major economies. The People's Bank of China reported adding to reserves for 18 consecutive months. The Central Bank of Russia, despite sanctions, continued accumulating. Poland's central bank announced it wanted gold to comprise 20% of its reserves. Even Singapore, known for its conservative monetary policy, was quietly building a gold position. The question strategists were asking was simple but profound. Why? These central banks had access to the best economic data, the best forecasters, the best intelligence. They knew something, and whatever they knew was serious enough to abandon decades of dollar-denominated reserve policy. The technical picture painted by market analysts showed no resistance levels above $3,000. The charts were in what traders call blue sky territory. There were no previous peaks to act as selling pressure, no psychological barriers. The path of least resistance was up, but buried beneath the headlines and the price charts was a deeper transformation. For decades, the price of gold had been determined in two places, the London bullion market and the COMEX futures exchange in New York. These were paper markets. Traders bought and sold contracts representing gold, but rarely took delivery of actual metal. The price was set by sentiment, by speculation, by algorithms. That system was dying. Physical buyers were no longer accepting the paper price. Premiums for actual coins and bars were spiking. In some markets, buyers paid 15% above the spot price just to get real metal. The paper market was becoming irrelevant. The real price was being discovered in vaults, not on screens. And that price was rising. There was a room in Basel, Switzerland, where 23 men made a decision that would eventually move $3 trillion. The year was 2019. The room belonged to the Bank for International Settlements. The decision involved a single word change in a banking regulation document. The word was gold. Nobody paid attention at the time. By the time gold hit $3,000, that word change had triggered the largest coordinated asset reallocation in modern financial history. But to understand why institutions were panic buying precious metal, one had to look at what was happening to money itself. Between 2020 and 2025, the United States Federal Reserve expanded its balance sheet from $4 trillion to $9 trillion. This meant the central bank had created $5 trillion out of nothing. It bought government bonds. It bought mortgage securities. It injected liquidity into markets that were freezing up. Other central banks did the same. The European Central Bank, the Bank of Japan, the Bank of England. Money printing became the only policy tool that mattered. The problem was simple mathematics. When the supply of something increases dramatically, its value decreases. Every economic student learned this principle in their first semester, but somehow policymakers believed currency would be different. They believed they could print unlimited amounts without consequences. The consequences arrived in slow motion. Then all at once, real interest rates, the return on bonds after accounting for inflation, went negative in most developed economies. This created an impossible situation for savers. A German citizen putting money in a savings account was guaranteed to lose purchasing power. A Japanese retiree holding government bonds was watching wealth evaporate in real terms. Institutions managing trillions in assets faced a crisis. Where do you store value when every traditional safe haven is paying negative real returns? The answer was showing up in central bank reserve data. In 2000, central bank gold reserves totaled approximately 32,000 tons. By 2025, that number had grown to over 36,000 tons. But the composition had shifted dramatically. Western central banks had been stable or slight sellers. Eastern and emerging market central banks had been aggressive buyers. China's official gold reserves had grown from 600 tons in 2000 to over 2,200 tons in 2025. But analysts suspected the real number was much higher. The People's Bank of China only reported purchases sporadically. Months would pass with no updates. Then suddenly they would announce they had been buying the entire time. Russia told a similar story despite sanctions. Despite being cut off from Western financial systems, despite economic pressure from every angle, Russia kept buying gold month after month, year after year. The strategy was becoming clear. These nations were building insurance policies. They were preparing for a world where the dollar might not be the dominant reserve currency, where sanctions could freeze digital assets with a keystroke, where only physical, non-confiscable wealth would matter. Turkey provided a case study in real-time currency collapse. The Turkish lira lost 80% of its value against the dollar between 2018 and 2024. Turkish citizens who held lira in bank accounts watched their savings disappear. Turkish citizens who held gold preserved their wealth. The lesson was not lost on other nations. Government debt levels were reaching levels previously seen only during world wars. The United States debt to GDP ratio exceeded 130%. Japan's exceeded 260%. Italy, France, Spain all carried debt loads that would have been considered catastrophic a generation ago. But the debt couldn't be paid back in real terms. The mathematics didn't work. Part 2. Macroeconomic forces and institutional behavior only solution was inflation. Print money, devalue the currency, make the debt smaller in real purchasing power terms. Bond investors were starting to understand this. For decades, institutional investors treated government bonds as risk-free assets. Pension funds, insurance companies, endowments, they all held massive bond portfolios. But those bonds were now offering returns below inflation. They were guaranteed losses. The smart money was moving. Sovereign wealth funds, pools of capital managed by nations, were quietly reducing bond exposure and increasing alternative assets. Norway's government pension fund, Abu Dhabi Investment Authority, Singapore's GIC. These were not speculative hedge funds. These were the most conservative institutions on the planet, and they were buying gold. When the printers of money stopped trusting the money they print, when the lenders to governments stopped trusting government promises, when the guardians of national wealth choose metal over paper, the signal is unmistakable. The $3,000 price wasn't a bubble. It was a vote of no confidence in the entire system. The transaction happened at 2:47 a.m. Beijing time. A Chinese oil tanker docked in Saudi Arabia. The cargo was loaded, but the payment didn't go through New York. It didn't touch the SWIFT system. It didn't involve a single US dollar. The Saudis accepted payment in yuan, backed by gold, settled through the Shanghai Gold Exchange. When Western intelligence agencies pieced together what had happened, they realized the unthinkable had occurred. The petrodollar, the 70-year arrangement that forced the world to buy oil in US dollars, had been bypassed. This wasn't theory anymore. This wasn't a conference room debate about the future of reserve currencies. This was a live transaction. Real oil, real payment, no dollars involved, and it was just the beginning. For decades, the US dollar enjoyed a privilege no other currency possessed. It was the global reserve. Nations needed dollars to buy oil, to settle international trade, to hold as reserves. This created automatic demand for US currency and US debt. That demand allowed America to run deficits that would bankrupt any other nation. The world needed dollars so America could print them and export inflation to everyone else. But that system required trust and cooperation and a world willing to accept American financial dominance. That world was ending. The BRICS nations, Brazil, Russia, India, China, South Africa, had been meeting annually for years. Western media dismissed these meetings as symbolic photo opportunities with no real substance. But behind closed doors, these nations were building infrastructure for a parallel financial system. Russia had been cut off from SWIFT after geopolitical tensions escalated. The message was clear. Step out of line and we can delete you from the global financial system. Your banks can't transfer money, your businesses can't trade, your economy freezes. But Russia didn't freeze. It adapted. It began settling trade with China and rubles and yuan. It built alternative payment systems, and most importantly, it stockpiled gold. Physical gold cannot be sanctioned. It cannot be frozen by executive order. It exists outside any nation's control system. China was watching and learning. The Chinese government understood that as long as the world ran on dollars, America held ultimate power, financial power, the power to exclude, to sanction, to control. So China built alternatives: the Cross-Border Interbank Payment System, the Asian Infrastructure Investment Bank. The Belt and Road Initiative created trade routes that bypassed Western financial choke points. And underneath all of it, gold. China wasn't just buying gold for its central bank reserves. It was building the Shanghai Gold Exchange into a rival to London and New York. It was creating yuan-denominated gold contracts. It was offering trading partners the option to settle in currency backed by metal instead of currency backed by debt. The strategy was elegant. As gold prices rose, China's reserves appreciated. The UN gained credibility. The dollar lost its monopoly. India joined the movement from a different angle. Indian citizens had always loved gold. Cultural tradition, wedding customs, distrust of paper currency. For decades, the Indian government tried to discourage gold buying. They wanted citizens to trust banks, to invest in bonds, to support the rupee. But Indian citizens knew better. They kept buying gold. Over 25,000 tons of private gold holdings, more than any other nation's citizens. When the rupee weakened, gold protected them. When inflation spiked, gold preserved purchasing power. The wisdom of generations proved correct. Now the Indian government changed its position. If you can't beat them, join them. India began accumulating gold reserves. It started exploring gold-backed trade arrangements. It positioned itself as a bridge between East and West in a fragmenting monetary system. The Global South was watching all of this with intense interest. Nations in Africa, Latin America, Southeast Asia, they had been burned by dollar dependency before, currency crisis, IMF bailouts with harsh conditions, debt traps denominated in currencies they couldn't print. Gold offered an escape, a neutral asset, no allegiance to Washington or Beijing, just value, portable, divisible, accepted everywhere. As tensions rose between major powers, as trade wars escalated, as sanctions became routine tools of statecraft raft, gold became the Switzerland of assets, neutral territory, and a weaponized financial system. The $3,000 price reflected this new reality. It wasn't just inflation, it wasn't just monetary policy, it was the market pricing and fragmentation, pricing and conflict, pricing in a multipolar world where trust was scarce and gold was the only universal language that remained. The old order was dying. The new order was being born in gold. The email arrived at 6:15 a.m. in the inbox of every major pension fund manager in North America. Subject line: Gold allocation review required. Inside, 3 sentences from the Chief Investment Officer. Gold is now 8% of portfolio value due to price appreciation. Clears throat. Original allocation target was 2%. Board meeting Friday to discuss rebalancing. This email multiplied across thousands of institutions represented $1 trillion question. Do we sell the gold that just made us money, or do we buy more? The traditional portfolio allocation model was breaking down in real time. For 40 years, financial advisors followed a simple formula: 60% stocks, 40% bonds, maybe 5% alternatives if you were aggressive. Gold was considered a fringe asset, something conspiracy theorists bought, something your paranoid uncle kept buried in the backyard. But at $3,000 per ounce, gold was outperforming every major asset class. The traditional 60-40 portfolio was underperforming inflation. Bonds were losing value as interest rates fluctuated. Stocks were volatile and disconnected from economic fundamentals. The institutions that had ignored gold for decades were now scrambling to understand it. Portfolio managers pulled up correlation studies. Gold's price movement had low correlation with stocks. This meant when stocks crashed, gold often held steady or rose. It provided genuine diversification, not just on paper, but in actual crisis conditions. The 2020 pandemic crash proved this. Stocks fell 30% in weeks. Gold rose. The 2023 banking crisis repeated the pattern. Regional banks collapsed. Gold spiked. Every time the system showed cracks, gold filled the gap. But buying gold at $3,000 felt psychologically difficult. Humans are wired to buy low and sell high. Gold had never been higher. Every instinct screamed, wait for a pullback. Yet, the fundamentals suggested otherwise. Mining company executives were dealing with a reality that most investors didn't understand. The cost to pull gold out of the ground had been rising for years. Energy costs, labor costs, equipment costs, environmental regulations, permitting delays, the all-in sustaining cost. The true expense of mining an ounce of gold now averaged between $1,800 and $2,000 across the industry. Some operations were even higher. This created a floor. Mines couldn't operate at a loss indefinitely. If gold dropped below production costs, Part 3, geopolitical realignment and systemic risks, mines would close, supply would decrease, prices would stabilize. At $3,000, mining companies were suddenly printing money. Their profit margins had doubled or tripled. A mine that struggled at $2,000 gold was now a cash machine. But here was the opportunity most investors missed. Gold mining stocks were still trading at valuations from the $2,000 era. The market hadn't fully priced in the new reality. This created what analysts call a valuation gap. The metal had moved. The stocks hadn't caught up yet. Historically, mining stocks amplified gold's movements. When gold rose 20%, mining stocks often rose 40 or 60%. They provided leverage to the underlying commodity without using actual financial leverage, but they also came with risks. Mining stocks were still stocks subject to management decisions, operational problems, geopolitical issues, and mining jurisdictions, currency fluctuations. For institutions considering exposure, the choice came down to physical versus financial. Physical gold meant coins or bars stored in vaults. Insured, secure, but expensive to store, difficult to sell quickly, no yield or dividend. Financial gold meant ETFs or futures contracts, easy to buy and sell, low storage costs, but counterparty risk. You owned a claim, not the actual metal. The sophisticated players were doing both. Physical gold is the core strategic holding. Financial gold for tactical trading and liquidity. Tax considerations added another layer of complexity. Different jurisdictions treated gold differently. Some considered it a collectible with higher tax rates. Some treated it as currency. Some offered exemptions. The regulatory landscape was shifting too. Governments watching gold soar were considering their options. Transaction reporting requirements, purchase limits, windfall taxes. History provided a warning. In 1933, the U.S. government made private gold ownership illegal. Citizens had to sell their gold to the government at a fixed price. Then the government immediately revalued gold higher. Could it happen again? Unlikely in the same form, but some form of intervention seemed probable if prices continued rising. The professionals building positions understood something crucial. This wasn't about getting rich quick. This was about not getting poor slowly. Gold at $3,000 wasn't expensive. The dollar at its current value was cheap. The decision framework was simple. Determine risk tolerance, allocate accordingly, verify sources, store securely, think in decades, not days, and understand that this analysis was educational perspective, not financial advice. Every individual situation was different, every risk profile unique, but one truth remained constant. Those who understood monetary history were not surprised by $3,000 gold. They were preparing for $4,000.